I often mention decentralized finance or DeFi in my videos, but I realize I have never made a thorough explanation of what DeFi actually is. So today I'm going to use very simple and plain English to try to explain that for you. Now, in order to understand DeFi, you need to be somewhat familiar with what financial services you can get with traditional finance, like earning interest rate on your savings, borrow money for your house, invest in stocks and bonds, exchange currencies, trade options and futures, and so on. And DeFi offers the same financial services like saving, lending, borrowing, exchanging, investing, and trading. The main difference between traditional finance and DeFi is that DeFi does not require you to go through an intermediaries like a bank or a stockbroker to get those financial services. DeFi relies on different smart contracts to provide you all those financial services. And because the smart contracts are deployed on a blockchain like Ethereum, so it is decentralized without any jurisdiction. Anyone from any corner of the world with internet connection can participate in DeFi. This is very different from traditional finance, or I would rather call it centralized finance. In centralized finance, you have to meet certain requirements in order to open accounts in banks and stockbrokers. There are still over 1 billion people without bank accounts in this world. Even with a bank account, and after putting your hard-earned money into those accounts, you do not have full control of your money. Those intermediaries have full control of your money and have a final say of what you can or cannot do in their accounts. They may say you are not qualified for a loan or a credit card, and they can refuse any type of financial services that you request. Well, on the other hand, DeFi opens up every type of financial services for everyone. Now, for DeFi to function properly and provide the financial services that we all need, there are some key components that are required. The first one is, of course, a stable currency, or a stablecoin we call it. Because a stablecoin can provide a unit of measure for value similar to how we traditional finance uses fiat currencies to value whatever we buy, sell, borrow, and lend. So it is essential to have stablecoins that are stable, reliable, and scalable. The adoption of DeFi really took off when the stablecoin market grew exponentially last year. I have made several videos on the stablecoin topic. If you are interested, I will leave the link in the description below. The second is Decentralized Exchange, or DEX. The DEX provide you the possibility to exchange your cryptos directly in your wallet. For example, Uniswap is an Ethereum blockchain DEX, and you can exchange ETH and any ERC tokens on the Ethereum blockchain by using Uniswap. You do not need to sign up an account on Uniswap. You can simply connect your Ethereum wallet, like MetaMask, with Uniswap and perform the exchange directly. Unlike the centralized exchanges that use the order book to match the buy order with sell order and execute order, decentralized exchanges use mostly automated market maker, the AMM, to execute the full order immediately. The algorithm behind AMM is basically the simple supply and demand mechanism. But in order for AMM to function efficiently, it relies on the liquidity providers. The interesting part is we all can be a liquidity provider for the DEX. And the DEX incentivizes us to be a liquidity provider by paying us a portion of the transaction fees. I will make another in-depth video on how DEX works and how to use DEX like Uniswap to exchange tokens or to earn liquidity provider fees. If you are interested, then make sure to subscribe and stay tuned for the video. The third is lending and borrowing. Lending and borrowing have been and will continue to be the biggest money market in the world. So it is important for decentralized lending and borrowing protocols to offer better service in this market. Unlike the traditional lending and borrowing, DeFi lending is anonymous. So in order to ensure that the borrower doesn't just take money and run away, DeFi lending is mostly over-collateralized, meaning a borrower has to put down collateral which has greater value than the amount they are going to borrow. For example, if you want to borrow $100, you have to lock at least $150 worth of ETH in the smart contract. So in this way, even if you don't pay back the $100, the smart contract can sell the ETH and pay back to the lender. The smart contract also protects the lender from the collateral price swings as well. In the same example, if the ETH price were to drop 30%, the smart contract will automatically sell the ETH and pay back the lender. Although it sounds that the lenders are quite secured in the lending protocols, there are risks of protocol bugs and exploits. I'm planning to make some videos on the most popular lending protocols and how to use them to generate yield for your crypto assets. Please leave a comment to let me know if you are interested in such topics. The fourth is, of course, insurance. Currently in DeFi, insurance is still quite small and young as compared with other DeFi services. But I think it has a big room to grow, and it is very important for the investors and lenders in the DeFi ecosystem. Considering that our real-life assets and investment are mostly insured to some degrees. In the same example of the lending protocols, if some bugs got discovered in the protocol and were exploited, the funds are gone. If a lender has bought insurance for the money lended out, in the event of the bug's exploits, the insurance protocol will pay you back the money instead. So that's the short and simple DeFi explanation. I hope you learned something from this introduction video. Please smash the like button if you enjoy this content, and that's it for today. I will see you in my next video. Bye!